In Chapter 2, we were talking about balance sheet transactions. Chapter 3's topic is income statement transactions. So we're going to go through a lot of the same things we did with Chapter 2, except we're going to be looking at income statements. And the income statement is based on operations. So we have said before it has to do with how successful the business is. In this PowerPoint, the first PowerPoint for Chapter 3, I'm going to be covering Learning Objectives 1 and 2, which means we're going to have to talk about the income statement account and those titles, what are common operating transactions, and we're going to be talking about revenue and expense recognition principles. This is a little tricky, because most of the other transactions we have been talking about have been based on when the cash either came into the business or left the business. And when we start talking about revenue and expense, we have other rules, and our rules that have to do with when we do the journal entries and when we put it in our accounting system are different from cash flow, quite different. And so this this PowerPoint presentation is about this. So Learning Objectives 1 and 2 will be in this PowerPoint, and then 3, 4, and 5 will be in the second PowerPoint, which has to do with Chapter 3. Income statement activities are operating activities. And operating activities, if you're a merchant and you're selling products, it would be buying and selling of your products. You could also be someone or a business that provides services, and services generally involve labor or extra expertise and the ability to perform some function. The same thing applies in that. These are operating activities, and it's providing goods or services to customers. And some businesses, like the business we have in our examples in the textbook and within the PowerPoint, do both. They provide goods and they provide services. And there's a cycle, and that's why we are looking at this, and there's a circular motion here, starting with 1, going to 2, going around to 3, and going around to 4. Because we're talking about the operating activities that are happening in a business and how accounting has to record all of this. Now, before the business can sell anything, they have to be prepared to provide. So, if it's a service industry, or even if it's a business that provides goods, the business may need to go out and purchase supplies. In 1, we see the business is going to receive in $30 worth of supplies, and they're going to give a promise to pay, which we know to be an accounts payable. Then in the second step, they have to pay, and they have to pay their suppliers, and they also have to pay their employees for providing for them. So here we have the supplies which were purchased that they need to now be paid for. This created an accounts payable up here. This is the release, is what they're calling, the release from the promise. What it is saying here is that we are paying the cash on the debt which we owed in 1. Now, having bought the supplies, now we can go out and we can provide the goods and services. Now, note here that while we are talking here about buying supplies, we could also be talking about a business that is providing goods for sale. So the business would be buying up inventory, creating an accounts payable, paying off the accounts payable, and then over here selling the goods. Now these things, 1 would happen first and then 2, and we know that the goods, after the goods come in, they can be sold. So we really don't know if 3 here would happen before 2 or after 2, but we do know that once the goods are in, the whole point is going to be to sell those goods. That's going to be the purpose, the goal of the business. So they're going to sell their goods, and if they provide services, they're going to provide services. In this instance, they provided services at a price of $50, and the business receives the right to collect the $50. What they're saying here is that we have sold something, we have provided the services, and we have not been paid directly. In the previous PowerPoints, we learned this was an account receivable. And we also learned that this process of selling goods and services is revenue. So now we're going to start talking about revenue, and this is the revenue part. Now this over here, 1 and 2, should be something we've seen before in the previous PowerPoints. We haven't seen this though, the selling of goods and services. I think also we had in our previous PowerPoint 4 where we are collecting our cash from our customers. So the customers have given us a promise in 3, and they're going to pay us, but they don't pay us until 4. Okay? So when we're talking about operating activities, I said down here in red in this bold box that it's helpful to think of operating activities as those things that the business is meant to do. And now, since this operating activities are the things that show up on the income statement, it's beginning to make a little more sense why I said earlier that the income statement some people feel is the most important of the 4 statements, the 4 financial statements that we have, because it really talks about operations and how successful the business's operations are. So the operating activities are buying goods and services for sale, paying for those goods and services that they have bought, selling the goods and services, and collecting cash. They wouldn't have to wait to collect the cash. There are cash sales made. People go into Walmart, for example, and pay with cash. There we could also go out and we could buy things, inventory, items we want to sell, and pay cash for them. So it isn't necessary that we separate 1 and 2, or we separate 3 and 4. We could have revenue generation with cash coming in at the same time, or we could have buying of goods and services that we're going to sell and have the cash coming in at the same time as well. So it's possible that these could all be combined. But the operating activities are buying and selling of goods and services. That's just what operating activities are. And the income statement is the way we measure our success. On this income statement then, this is really more explicit than you probably need. We said before that the top part of the income statement names the business. The second line of this is the header, is the title of this statement, which is an income statement. The second line talks about what period of time it's covering. This is for the month, and the month ends September 30th. Now the implication from this, if this is for the month ending, this must be the revenues that happened during September then. So September 1st through September 30th. This represents the revenues. They have revenues from selling products, and they sell apps, it says over here. And they have revenues from providing services related to the apps, and that's explained over here. The expenses are the things that are necessary to go along with providing the sales, the products, or the services. So we have to pay our employees wages, we have to pay them salaries, we have to pay the rent, we have to pay utilities, we have to insurance, we have to advertise so people will know to come to our store or to purchase from us. And if we have net income, we have to pay income tax. That's just a requirement. And then we get down to net income, which we said before is the difference between revenues and expenses. So this is just a review right here. And the time period which we're using here is in a month. It could be other time periods, and I believe I've talked about that before. Now, the cash basis of accounting says that when you re-record revenue, you will record revenue when the cash is received, and you record expenses when the cash is paid. Now, this is not GAAP. This is not GAAP. And only very small companies that do not issue stocks can use the cash basis. Instead, what we do is follow GAAP. Now, GAAP is spelled over here. Generally Accepted Accounting Principles. It's called GAAP. And GAAP are the rules that we have to follow when we record revenues and expenses. Now, if you could record your revenue when you get the cash in, then you would try to get people to pay you early so that you could manipulate your income statement, so that your income statement would show more revenues because you're basing it on when cash comes in. Likewise, if you want to have lower expenses, so your net income would be higher, all you have to do is postpone your payments. And so what came out of this when we were on the cash basis is that people could manipulate their financials by making people pay them early for things that they hadn't provided, and they would then hold their checks back or not pay people until they really had to pay them so that they could manipulate the financials and keep those expenses low. So to keep everyone on the same page, we have rules, and the rules say we cannot use cash basis, except, as I say up here, if you are a very small company that does not issue stock. So that means we have to have rules. We can't just say, oh, when the cash comes in, we have revenue, or when the cash goes out, we have expenses. Now, we know this first learning objective. We know that the common operating activities or transactions for a business are providing services, selling products, paying the bills, and buying those products to sell, and also the cash coming in. We're going to use T accounts, we're going to use ledger rules, but first we really need to start talking about GAAP and what GAAP is and how GAAP affects everything. So the second learning objective that I want to cover in this set of PowerPoints are rules for revenue expenses, GAAP. And the first part of this is called the accrual basis of accounting. So we said we should not be using the cash basis. We should not be basing our revenues or expenses based on cash coming in. If we don't do that, then how are we going to do it? And this is called accrual. This word up here, accrual. And sometimes you hear the word deferral. Whether you hear the word accrual, whether you hear the deferral, all it means is you don't record revenue or expenses based on cash flow. Instead, you have other rules, and this is the basis, the accrual basis. A matching principle will be applied to expenses, and we'll talk about that in a minute. Now, what does this accrual mean? We said it's the opposite of cash. Well, the other side to cash, the cash basis of accounting. If you don't use cash basis, you use accrual. Accrual basis is GAAP. And in this, you get to record the revenues only when you earn them. So in other words, the company has to do something that shows that they have earned the revenues. If the company is providing services, then substantially all the services that their contracts say they should be doing are done before they get to say they have revenues. Now, the expenses should be recorded in the same period as the revenues. Why do we say this? Well, we say this because when we create the income statement, we need to be able to look at it and match what our expenses are to our revenues. In a previous PowerPoint, we had a movie theater, and in the movie theater, they were selling products that people would consume, right? And we discovered that there was a big margin, or there was a lot of money being made off of the difference between the cost of those concession stand, or the amount of money that's going into the concessions, and the revenues coming off the concessions. If we didn't use the accrual basis of counting, which provided this matching of expenses to revenues in making that income statement, we couldn't have seen that. And so when we use the accrual basis of accounting, to recap it, record revenues when we have done the thing we should have done, substantially completed all we need to do according to the contract, and we record the expenses in the same period in which the revenues are that they relate to show up. Now, revenues are recognized when they are earned. So I said as soon as they have completed the work, if it's a service contract. If it's a product that's being sold, generally it's when that product leaves. So if you go into Walmart and you make a purchase from Walmart, Walmart gets to record the revenue when you walk out the door with the product. If you live in your home and you need a new air conditioner, when the air conditioner is delivered to your house, then the company that sold you that air conditioner, then they can record the revenue because you have it, you have possession of it, and you can use it. So you've heard the expression, possession is 9/10 of the law. It applies in accounting too. Once we have possession of the product, then it is passed over to the customer, and then the company can record the revenue. In this first example, this is a very detailed slide here, but there's a lot of important information in it. We have cash received from a customer, and we have a promise that we are going to do something in the future. Because we have not done anything, we cannot record revenue. Okay? Instead, what happens is you record a liability. You can't record revenue because you only have a promise to do something. It hasn't been done. Once you do the thing, though, you no longer have a liability owed to that customer for something to be done because you've done it. And once you do it, you have revenue. So a promise to provide is not adequate. We recognize the liability when the promise is given, but not the revenue. And when the promise is made good, we recognize revenue. Now sometimes we actually get, so in this first instance, we get the cash before we actually do anything. Cash coming in early, you record the cash because you have the cash, but you don't get to record the revenue. You defer or you wait until you actually do the service to record the revenue. The next instance would be something like when a customer goes into Walmart and pays with cash. If they're paying with cash and the person walks out with the product, then when this happens, you get to record the revenue. In this instance, it's not a product, it's service that's being provided. So let's say someone comes to your house to fix your air conditioner. They come to your house, they fix your air conditioner, and you pay them with cash. Well, at that point, they're going to be able to do a journal entry which shows an increasing assets, which is their cash, and they're going to be able to record revenue. On this next example, what's going to happen here is we are going to wait to get paid. In other words, we're going to provide the services and we're going to bill. I have someone that comes to my house and they provide services for me. They are plumbing and heating and air conditioning service repair people. They come, they provide the service, and they send me a bill. Well, this to that company then would be recorded as a receivable because it is a right to receive cash in the future, and that's why we call it receivable. So we have this receivable gets recorded, and because the service has been provided and my air conditioner now works, they get to record revenue. Over here then we're swapping out of assets, and I will send in my check once I get the bill. I send the check in. The check is like cash, and it gets recorded as cash by the customer, and they take off their books the receivable. So they can no longer say that they have an accounts receivable when they get the cash in. So there are all these different possibilities that can happen for a company. A company can get cash in the first example. They get the cash in before they did anything, in which case they record the cash and a liability, and then when they do it, they remove the liability and create revenue. They can get cash at the same time when they provide the service, which there's only one journal entry required here, which is cash being debited or cash coming in and revenue being recorded. Or they can provide the services and then not be paid at this time and wait later, and then later on they get the cash in. And in all of these instances, you will notice along the middle line here, when the service is given is always when the revenue is reported. So the rule up here again is revenues are recognized when they are earned, and earned means a service provided. Again, if it's providing not a service but a product, it usually means delivery or possession. So when the customer takes delivery or possession of the product, that's the time when you record the revenue. Now, when you do the work, when you get the cash in, or when you get to promise to pay, or when you fulfill the obligations, when again should you record the revenue? The answer to this is twofold. When you do the work, and we call this earning, right? And when you no longer have other obligations associated with this work out there. So when you substantially complete the work, when you substantially complete your work that you're obligated to provide, this is when you should record that revenue. Just as we were talking about revenues then, let's talk now about our rules about expenses. And this is called the matching. And I said it's called matching because when we prepare our financial statement, we want it to show both the revenues and the expenses associated with generating the revenues so that the reader can see what it really costs us and what we get out of it when we provide services or when we provide products. Like the others, we're going to have three cases here. We can pay cash for supplies. Now the supplies are not used up at this point. We haven't used up the supplies. We just have the supplies, and the supplies are in a cupboard somewhere and waiting to be used. We don't record these as an expense when we have them. Instead, they're an asset. And what we do is we use up the assets, and the assets, as they are used up in producing revenues, become expenses. And the neat thing about all of this is when we work through it, then we will see that the expenses and the revenues are matched up when the income statement is prepared. So in the first instance, we are swapping cash for supplies. I think we had this transaction in a previous slide. Now we are doing something new which we have not talked about, and this is called what I call expensing of assets. So we take the supplies up, we use them up, we take them off our books by reducing them, by crediting the asset account supplies, and we record an expense. Because you need to be recording the expenses when the supplies are used up. The second example is electricity or utilities. Now I've said before, the thing about utilities is you don't really have anything left after you pay it. You pay your rent, there's nothing left. You don't have anything tangible of value, and an asset is a thing of value. So when we use up our electricity, we will use it up, we will pay cash, and we will record it as an expense. We're not going to record it as an asset, we'll record it as an expense. And this expense is a necessary part of doing business because we have to have electricity in our shop, in our business, in our retail floor, so we can sell the products and provide the services. Now, let's say in this last instance that we have advertising done. We have advertising, we put an ad, or we distribute a flyer with the newspaper. You've all seen these. Well, the ad has to do with a time period and a particular time period when our sales will be. So obviously what we would want is we would want the ad to go out at the same time as the sale. What's going to happen is the newspaper is going to send us the bill, and we are going to pay the bill later. Again, the ad relates to the sale, which is happening during a time period. Therefore, we want this expense to be recorded right here. So the expense should be reported at this point when we actually have the advertising provided. So, again, what we see happening here is when we use things up, or we get the benefits of these, And it's going to help us. It's going to help us make sales. It's going to help us provide services. When those things happen, they show up on our income statement. Later on, we are going to pay for this advertising. We owe them for the advertising from the moment they put that ad in the paper, or we ask them to put the ad in the paper. So we create a liability, and then later when we pay for it, the liability goes away. This is very similar to what we had with revenue. And here we have the liability going away at the end. We also had, when we were talking about revenue, an example where we had cash coming in. I think it was up here, and it was with revenues. When the cash came in the beginning, we then started owing a liability to the customer to provide them with services or with goods in the future. So, the timing of reporting of expenses versus cash payments. This is the matching principle. And again, when we do the things which use up our assets or which use up our supplies here, or assets are being used up, and here we are paying the cash to have it go out, or here where we have a contractual arrangement where they're putting in the advertising that's related to the sales. All these examples, the using up, suggest that at these points we record expense. And it just happens to be that cash and the using up is happening at the same time. Here we have cash happening before we use up our supplies. Here we have cash happening after we got the benefit of the ad. So cash flow and expenses don't happen at the same time when we're using this accrual basis. When do we record an expense then? Expenses should be recorded when we get the benefits from their use. If we pay for a year of insurance in advance, we do not record it as insurance expense on that time when we pay for it. Instead, we record 1 month of insurance expense on the income statement in that particular month. So, the answer to this one is C, when you receive the benefit from its use. And D, you're going to use the matching principle. So you have to stop and you have to think, and you have to think about, when am I going to get the benefit from this? In our example with advertising, when do we get the benefit? When the ad goes in the paper and when those sales start coming in. This is when we see it. Okay, I'm going to stop right here, and we'll start our second PowerPoint with Learning Objective 3.